Hey everyone, welcome to the StoxCompare Explainer. Let's just dive right in, shall we? Today, we are popping the hood on the absolute financial machinery of Yum Brands. We really want to answer the ultimate question here. Is this fast food giant a buy, a sell, or a hold?
To figure that out, here is our roadmap for today. Number 1, we'll look at the Pizza Hut divestment. 2, top line and cash generation. 3, driving shareholder value. 4, the hidden balance sheet risks. And finally, number 5, the final verdict.
All right, starting us off with Section 1, the Pizza Hut divestment.
So, Yum operates a legendary portfolio, right? And it's actually pushed the stock up 10% over the last year and a solid 30% over the last 5 years. Brands like KFC, Taco Bell, and the Habit Burger Grill have been absolute powerhouses. But price action is always a lagging indicator. We have to dig deeper and ask ourselves, do the underlying financial metrics and the massive strategic shifts happening literally right now actually justify this run?
Well, this brings us to the absolute headline shock from June 2026. A massive $2.7 billion deal that completely sheds nearly 20,000 Pizza Hut locations. Now, you might be wondering, why say goodbye to such an icon? Well, frankly, Pizza Hut was just losing the delivery war to Domino's, and it was really struggling to adapt its legacy sit-down model. So they're selling off this drag. $1.5 billion goes to LongRange Capital, and $1.2 billion goes to Yum China. The end result? Yum walks away with $2.3 billion in pure net proceeds after about $85 million in one-time transaction expenses. It is a huge pivot.
Moving right along to Section 2, top line and cash generation. Let's see how the engine is actually running.
Now look at this relentless top-line growth. It's kind of incredible. Revenue has just climbed steadily, going from $5.625 billion back in 2020 all the way up to $8.214 billion in 2025. It has literally been compounding like a machine. But okay, here's the catch we need to talk about. Taking Pizza Hut out of the equation completely resets this trajectory. So the big billion-dollar question is, does this move leave a leaner, much faster-growing core business behind?
Earnings can sometimes be finessed by clever accounting, but cash absolutely never lies. Yum consistently generates way more free cash flow than its reported net income. Back in 2020, they pulled in $1.145 billion in free cash flow on $904 million in net income. And by 2025, they hit a massive $1.639 billion in free cash flow against a reported net income of $1.559 billion. Guys, this is a masterclass. They are elite at converting operating income into pure, deployable liquid cash.
All right, Section 3, driving shareholder value. Let's see what's in it for the investors.
So like literally everyone else in the industry, Yum faced some serious food cost inflation. You can see that creeping in as gross margin slipped from 47.5% in 2020 to 46.2% in 2025. But here is where management actually crushed it. They beautifully defended their bottom line by ruthlessly leaning out corporate SG&A expenses. They trimmed that fat from 18.8% down to just 15.36% of revenue. And because of that amazing efficiency, they protected a highly lucrative, super stable operating margin, finishing 2025 strong at 31.36%.
And hey, if you hold Yum, you get paid. They returned a total of $1.341 billion to shareholders in 2025. But the really crucial takeaway here is how safe those rewards are. Their $789 million dividend, it consumes only 48.14% of their free cash flow. Anytime a company stays below that 50% safety threshold, it means the payout is highly sustainable and they still have plenty of dry powder left over for real growth.
Now, check out this absolute magic trick, share cannibalization. Management has systematically eliminated 24 million outstanding shares from the open market. They dropped the overall count from 302 million in 2020 down to 278 million over those 5 years. By aggressively eating its own shares, the company divides a growing net income among a continuously shrinking pool of shares. Basically, your personal slice of the pie just naturally gets bigger and bigger without you lifting a finger.
Okay, time for Section 4, hidden balance sheet risks. It's definitely not all sunshine and rainbows.
We really need to talk about the elephant in the room here. Franchise models usually carry high debt, sure, but Yum is operating with a staggering $11.91 billion debt load on its balance sheet. Their debt-to-equity ratio worsened from negative 1.742 in 2020 to a pretty alarming negative 2.119 in 2025. And their tangible book value? It's sitting deeply in the red at negative $9.203 billion. That means if they had to liquidate their physical assets today, they couldn't even come close to covering their liabilities.
Toss in a severe 7.6 times debt-to-income ratio, and you've got a glaring vulnerability, especially in today's interest rate environment.
Which brings us to Section 5, the final verdict. Let's weigh it all out. By cutting ties with a brand that was just clearly losing the delivery war, a much leaner Yum Brands is staring down a massive catalyst. You are going to want to circle July 30, 2026 on your calendar right now. That is the Q2 earnings call, and that's when management is going to reveal exactly how they plan to deploy all that new capital. This isn't just a sale. This is an addition by subtraction that fundamentally alters the entire DNA of the company.
So, what is the final StoxCompare verdict? We're calling it a hold for now, buy on the dip. Look, there is no denying this business is an absolute elite cash flow machine with highly stable margins and ruthless buybacks. But that $11.91 billion debt pile is incredibly heavy, and the deeply negative book value is a real risk. As we sit here waiting for that July 30th catalyst, you really have to ask yourself, is management going to use that $2.3 billion cash injection to fuel turbocharged, high-margin growth for Taco Bell and KFC, or are they just desperately plugging holes in a massive debt crisis? Keep a close eye on how they allocate that cash. Thanks so much for joining me for this StoxCompare Explainer, and I'll catch you in the next one.